Dr. Babasaheb Ambedkar Open University.
Hello my dear student and dear friend, I am welcoming you to all in the video lecture series conducted by the Dr. Babasaheb Ambedkar Open University Ahmedabad in a Chaitanya studio for the course of BBA regular. Subject code is BBA-202 Financial Management in block number 1 Basics of Financial Management, in that unit number 3 Sources of Short-Term Finance. Now let's begin our session with determining that particular chapter with its own learning objective, why we are studying this particular unit. That is most important thing in this particular chapter, that after learning this unit you will be able to understand that the need of short-term finance, short-term source of finance, importance and utility of each source of finance, special feature of each source of finance, then difference among them, the sources of finance. So ultimately these are the different learning objective for this particular unit called short-term finance or sources of short-term finance. Now let's begin our journey with the introduction point. From the viewpoint of time, there are mainly two types of source of finance, that is long-term finance and short-term finance. As we discussed in an earlier session, that long-term sources of finance or sources of long-term finance in a previous session, that is in unit number 2 of block number 1. Now in this particular session there are two types. So first, that is long term, and second is a short term finance. So both sources of finance have their specific role. A long term source of finance has relation with the capital budgeting decision. On other hand, short term finance has relation with the working capital management. Long term finance or long term source of finance are used for the long term investment, like investment in a plant, machinery, equipment, land, building, etc. While short-term source of finance, those type of source of finance whose duration of use is less than 1 year. Here the less than 1 year is equal to nothing but your short-term finance. If it is a greater than 1 year, then it will be for the long-term finance. Now let's begin with another topic, that is objective and features of the short-term sources of finance. First, that is to maintain the liquidity of enterprise. Then to meet the day-to-day requirement of routine business transaction. That means you require your working capital management and effective working capital management. Then the maturity period is less than 1 year, and then different source of finance. Then we can say that the different type of source of finance are available for the realization and utilization your fund for the 1 year only, and this indicates the short-term solvency status for the enterprise. Is it clear, my dear friends? Yes or no? Now movewards to the sources of short-term finance. So these are the different sources of short-term finance. First is trade credit, second is cash credit, then bank overdraft, letter of credit, factoring, call or notice money, then treasury bill, commercial paper, certificate of deposits, bill of exchange. So these are, my dear friend, the different sources of the short-term finance. So these are the important source of the finance for the short term, that is duration is nothing but less than 1 year or till the 1 year. Is it clear, my dear friends? Yes or no? Now let's begin our journey with the first source of finance, that's called the trade credit. This source of finance is a very conventional and popular in the business world. This trade credit is based on the norms of industry and the business relation between the business enterprise and suppliers. The term in trade credit means there are the certain terms are used for the trade credit. These terms are as follows, that is, first one is maximum credit limit, second is credit period, third is a starting date, fourth is a cash discount. First, that is a maximum credit term or credit limit. Then here the supplier determines the maximum credit limit to be given to the customer, and this credit limit in terms of the rupees is based on the two factors, that is standard of industry and second is relation with the customer. Second point, that is credit period, then it is the period of time for which the trade credit is made available to the enterprise by the supplier. Then starting date, This is the also important term of the trade credit period, and discount periods are based on this term. Then cash discount. This cash discount is the earlier in a different accounting methods, in a finance also, in a economic also. So these are the common term are there. So the cash discount means this is the one kind of incentive given by the supplier to the customer to make the payment before maturity date. It is one type of discount or reduction in a debt. That means if you charge 100 rupees MRP and the supplier give you the 10% cash discount, then you pay just 90 rupees. So ultimately this will be treated as the trade credit, and the different terms of in the trade credit also. Next, move on to the merits of the trade credit. The trade credit as a source of financing has the different advantages, or we can say the merits are there. In that, trade credit is readily available according to the prevailing norms. Then trade credit is a flexible source of finance which can be easily adjusted to the changing need to the purchaser or for the purchaser. Then the trade creditor generally adjusts the time payment keeping in mind past transaction with the customers. Then generally trade credit does not involve any flotation cost are there. Okay, my dear friends. Then move on to the second most important source of finance, that is cash credit. This facility is provided by the banker to their account holder and generally the customer. Under this facility, the customers are allowed to withdraw the money from their bank account more than their existing balance. The excess withdrawal amount is predetermined by the banker, and this amount varies to the customer It is only and only based on your account details, and we can say that you are maintaining your accounts detail and maintaining your accounts in an efficient manner. The cash credit facility is known as a short-term loan. In case of this source of finance, interest is charged on the amount of borrowing and not on the borrowing limit. And this service is provided by the banker on the continuing basis to his customer. And my dear friends, remember this facility may be varies from the customer to different customer also. Okay. Then the main features of the cash credit, that is, first is borrowing limit, second is interest on the borrowed amount, then minimum commitment charges, then collateral security and credit period. The borrowing limit means it is the limit based on the short-term loan provided by the banker. This limit is determined on the creditworthiness of the borrowers. A company can withdraw the fund up to its establishment, or we can say the established borrowing limit. Then interest on the borrowed amount. In the contrast with other traditional debt, financing methods such as a loan, the interest charge is only the amount that borrowed of the each cash credit account and not to the total borrowing limits. Then minimum commitment charges. The short-term loan comes with the minimum charges for the establishing the loan account regardless of the whether the borrowers utilizes the available credit or not. Then collateral security. The cash credit is often to secured using the stock, fixed assets or property as a collateral. Then credit period. The credit period is typically given to the maximum period of the 12 months, and after which the drawing power is re-evaluated. So that's why this is called a short-term sources. Is it clear, my dear friends? Then move on to the bank overdraft. Third most important source of finance, that is source of short-term finance, that is bank overdraft. It is short-term borrowing facility made available to the companies in case of the urgent need of finance, or we can say the urgent need of the few funds are there. The bank will impose the limit on the amount they can lend. When the borrowed funds are no longer required, they can quickly and easily repaid. The bank issue the overdraft with a right to cash them in a short notice. The main features are to avail the overdraft account facility. The bank account with respective bank is mandatory. Then money extension is granted on the basis of the customer's account value and the repayment history or the credit score. It is the short-term credit provided by the bank that need to be paid within the stipulated time period. Then credit amount or overdraft attract the interest for the time of use, which can be from 1 day to week or month also. Next is letter of credit. It is also the one-time short-term credit guaranteed issued by the bank for its customer. A letter of credit, in a short term we can say that the LC, or short form we can say the LC, is a financial document that facilitates the international as well as the domestic trade. It is an arrangement by the issuing bank on instruction of the customer or on its own behalf undertake to pay or accept or negotiate or authorized another bank to do so against the stipulated document subject to compliances with the specific terms and conditions. Then the documentary credit is considered as the best payment arrangement, since a reputed bank who pay against the presentation of the stipulated document as mentioned in the letter of credit. The main feature is, ultimately we can say that the features or characteristics are there, that is negotiability, then recoverability, then transferable, and site and the time based. In that first, the negotiability are there. The LC is usually considered as a negotiable instrument, can be passed freely. Then revocability, that is the LC can be either the revocable or irrevocable. That means if you are going for the revoke also, and you cannot be revoked also. Then transferable, the beneficiary of LC can be transferred easily. Site and time basis. A site form is paid when the LC is presented, and the time form is paid after a certain duration of the time. So that's why the differentiate, that is a site as well as the time based. Is it clear, my dear friends? Yes or no? Now moving towards our journey, that is factoring. Under this instrument, the trade debt of the firm is purchased by the financial institution at a discount. The factoring is a regular arrangement between the banker and client. Here, the banker is known as a factor. The factoring is a financial services which involve the meaning, financing and calculating the receivables, and the factor make the conversion or receivable into the cash possible. Factoring may be defined as a contract between the supplier of the goods or services. The core part or component of factoring is purchase of the book debt or receivables. The client, that is supplier, submit the invoices arising from the contract and of the sale of goods to the factor. The factor perform at least the two of the following services given. First, that is financing for the seller by way of the advance payment. Then maintenance of accounts relating to the account receivables. Then collection of account receivables and credit protection against the default in the payment by the buyer. So this four, out of this four, the minimum two condition or two services are required for the factoring. Is it clear, my dear friends? Then moving towards, that is call or notice money. This source of finance is deal in the overnight fund and deals in the fund for the 2 to 14 days. That is maximum time limit is 14 days, my dear friends, and minimum is 2. There are the two important parties, that is borrowers and lenders. According to the RBI, that is Reserve Bank of India guidelines, some parties can play the dual role of the borrowers and lenders. In case of the certain parties, their role is confined to the lending only, not borrowing, that is lending only. Now, who is the borrowers and lenders and only lenders? So, borrowers and lenders are all the commercial scheduled banks, cooperative banks, primary dealer listed by the RBI, and only lenders, that is selected all Indian financial institutions, selected insurance companies and selected mutual funds. So these are the different borrowers and lender and only lenders. Is it clear, my dear friends? Next, move us to the treasury bill. Another source of short-term finance is most important, that is treasury bill. There are three different entities which are using the specific source of finance to meet their short-term financial needs. And these entities are banks, business enterprise and government. These three entities are using specified source of finance, that is short-term finance, for their financial needs. The short-term finance needs of the government are met with the help of treasury bill. This is a very crucial instrument for the government. This bill are issued by the RBI on the behalf of the government, and this bill having the duration of 91 days, 182 days or 364 days. Out of this 3 days, the bill issued by the behalf of the government, that is for 91 days, 182 days or 364 days. There are two different types of treasury bills. First is general or regular bill and second is ad hoc bill. Now what do you mean by general or regular bill? So these bills are issued by the government for the public and other investors to make the short-term investment. While the ad hoc bills, there is no tender or auction process for this kind of bill. Ad hoc bill are purchased by the RBI from government and issue the currency notes also. Is it clear, my dear friends? Yes or no? Now moving towards, that is commercial paper. Very important source of short-term finance, that is commercial paper after the treasury bill. The commercial paper is a short-term issuance promissory note issued by the company in a private sector or public sector at such a discount or interest on a face value as may be determined by the issuing company and negotiable by the endorsement and delivery. So this is what, my dear friends, commercial paper. The commercial paper is an unsecured money market instrument issued in the form of promissory note, that is issued by the company. It can be issued by the corporate, primary dealer or all Indian financial institution. This instrument is issued at a discount to face value as may be determined by the issuer. The investment in CP, that is commercial paper, can be made by the individual, banking companies, other corporate bodies registered, or we can say the incorporated in India, and it is ultimately the short-term debt for the company. Is it clear, my dear friends? Yes or no? Next important point is certificate of deposits. Certificate of deposits is the receipt of a fund deposited with bank, which can be easily sold in a money market. This is an investment in the form of deposit where the time period is fixed. And this instrument increased the mobility of the bank deposits also. And this scheme first introduced in 1989, and bank accept the two types of deposits. That is, first is ordinary fixed term and second is certificate of deposits. In ordinary fixed term, that means such deposits are not negotiable instrument and therefore cannot be transferred in a favor of other person. That is fixed for the one person and for a maturity date. Another, that is certificate of deposit, that is, it is a negotiable instrument and therefore it can be transferred in the favor of other person by the endorsement or by the delivery. Is it clear, my dear friends? Yes or no? So this is what certificate of deposits. Next is bills of exchange. The bill the bills of exchange defined under section 5 of the Negotiable Instrument Act 1881. The bill of exchange is a written negotiable instrument that carries an unconditional order to pay a specific sum of money to a designated person or the holder of instrument as directed in the instrument by the maker. In the Negotiable Instrument Act 1881, three main negotiable instruments: promissory note, bills of exchange, and check. In that bills of exchange, it is the source of short-term finance. The bills of exchange is either the payable on demand or after a specific fixed term. Is it clear, my dear friends? Yes or no? Now, the question arises in your mind, that is, sir, how many parties are there for the making that bills of exchange? So, my dear friend, first party is drawer, second is drawee, third is pay, fourth is endorser, and next endorsee and the bearer. The drawer means the person who makes the bill or who gives the order to pay a certain sum of money in the drawer of a bill, that is instrument. Next is drawee. The person who accepts the bill of exchange or who is directed to pay a certain amount is called a drawee. Then the person receiving payment is called the payee, who can be a designated person or a drawer himself. Then endorser. The endorser is the person who transfers the rights of payment. Then endorsee. The endorsee is the person whose the favor of bills of exchange is endorsed by the drawer. Then bearer. The bearer is a person in the possession of the bearer of the bills of exchange. So these are the different parties involving in the bills of exchange. Moving towards this particular unit, let's sum up this unit with that. In a business organization, capital is an important element. The need of capital is categorized in the two categories, that is long-term capital and second is short-term capital. And accordingly, the sources of the both capital are separate from each other. The short-term need of capital having the duration of 12 months and in the fund required for the period is less than 12 months is considered as a short-term needs, or we can say the short-term finance. And moving towards are there, in this particular unit we studied that the different sources of the short-term finance, its features and objectives are there, and how to use it, how to utilize your short-term finance in an efficient manner, that is more important. So ultimately this particular unit and the previous unit, ultimately you determine it how to avail the fund and how to utilize that fund in efficient manner. With that, my dear friends, after watching this video and after reading the whole chapter or whole unit with respect to this particular subject, you have to evaluate yourself to write these two long questions. The first is differentiate between the money market instrument and source of working capital. Second is undertake the study on the different types of bills of exchange. That means that you have to evaluate the different types of bills of exchange with respect to determine the different parties are there. Is it clear, my dear friends? Yes or no? So you have to determine it in an efficient manner. After watching this video, just evaluate yourself with this few multiple choice questions. Let's begin with the first multiple choice question. That is, debentures are which source of finance? That is long term, short term, or bills of exchange? Answer will be long term. Why? because ultimately the maturity period is not for the 1 year, it may be extend to the more than 1 year. A bills of exchange is a negotiable instrument, a not negotiable instrument, then it is a negotiable instrument as per section 5 of the Negotiable Instrument Act 1881. Next is cash credit is provided to the client by, who will provide the cash credit? Bank, RBI, company or supplier? Answer is supplier. For a bank overdraft, interest is payable or not payable? Definitely they are in a business, so must be your interest will be the payable in nature. Then LC means, that is letter of credit means, letter of credit, LC means letter of credit. Yes, this is short term and they require the long for full form of the LC, that is letter of credit. Is it clear, my dear friends? Yes or no? So these are the different multiple choice questions. Let's move on to the sixth multiple choice question, that is collection of receivables is a function of letter of credit or factoring. Collection of receivable, we are not providing the, we have to receive something, then ultimately it's a factoring process. Next is the treasury bill are issued by the RBI or central bank. RBI for the central bank, not central bank for the RBI. Then commercial paper is not negotiable instrument or negotiable? Yes, definitely. All sorts of finance, source of short-term finance, all are the negotiable in a nature. Certificate of deposit issued by bank, company, what? Answer is banks. There are two types of deposits are there, that is ordinary fixed term and second is certificate of deposit. Yes or no? The Negotiable Instrument Act is of year 1981 or 1881. That is 1881. Here the typographical error are there. That is 1881. Is it clear, my dear friends? Yes or no? So this is what the multiple choice question for this particular unit, and you have to evaluate yourself with the long questions also. Now moving towards the different reference books are there, so you have to check it out by your own way and you refer the different reference books are also. These two books are for this particular chapters are there, that is Financial Management PC Tulsiyan and Bharat Tulsiyan, then Financial Management for the Ravi M. Kishore. After reading these books and your study material in an efficient manner, you will evaluate yourself that whether you are good in this particular unit or not. So first of all, watch this video. After that, evaluate yourself with these two long-term questions or long questions. Then the fulfill or the evaluate by the multiple choice questions also, and then move on to your reading material, that is study material, and then after go for the other reference books also. Hope you enjoyed this particular session while evaluating yourself in the era of financial management in the unit number 3 of block number 1, that is source of the short-term finance. Hope you enjoyed this video, hope you learn well in this video, and hope you do well in the future. We will meet in the next session with the new topic, with the new lecture, with the new era. Thank you very much, my dear student.
स्वाध्यायः परमं तप